This is the beginning of part 3 of our module on structured FRNs, which examines the construction and risk analysis of structured floating rate notes. We remind you that this part 3 contains chapters 5 and 6 of the module, with chapter 5 examining range accrual instruments and chapter 6 containing 6 quiz questions to test your understanding of these materials. This chapter 5 introduces range accrual instruments, which pay a higher yield than the market rate, provided some interest rate index falls inside a defined range. The principal building block for constructing a range accrual floater is the digital cap, which was discussed extensively in our module on interest rate options, an important prerequisite to this module. In that module, we explained that a digital cap is one that pays a fixed sum if it is in the money at expiration, irrespective of how far it has gone in the money. We also explained that a digital cap can be structured by simply buying and selling 2 caps with very slightly different strikes, but otherwise identical terms. We quickly review these 2 concepts on worksheet digital caps shown right here, but please revisit the earlier module if you are shaky on this material. Column I over here on this worksheet contains the prices of the caplets we priced previously, but notice that we have reverted in column D to the original LIBOR curve, which begins at 2.5% and then rises 25 basis points per quarter. Column U contains prices for caplets whose strikes are 1 basis point exactly in each case, higher than the caplets in column I. So 5.01 versus 5% here, but if you go further down the page, 451 versus 450 and 401 versus 4, and so on. Naturally, the slightly higher strike for the caplet in column U makes that caplet marginally cheaper than the caplet priced in column I, and this is true on every row. Finally, column Z or Z, depending on your nationality, that has just appeared now a little bit further to the right, contains prices for cap spreads, which consist of a long position in the more expensive caplet and a short position in the slightly cheaper one. So for example, according to the cell, an investor would pay a net premium of $746 that you see here for a caplet which combines, as now confirmed in the formula, going long the caplet from cell I13 and going short the caplet from cell U13, both expiring at the beginning of quarter 9, as we will show in just a second. Let's show that just before moving on, that this is indeed period 9. The payoff of this combination is what makes it so interesting and so powerful a building block for certain structured investment products. The table that has appeared now uses our standard notation to express the payoff under the caplet spread for the two alternative levels of LIBOR resets, where we are ignoring the case of LIBOR resetting somewhere in between 5 and 501. And this table confirms that the investor will receive on the expiration date in the last column either 1 basis point or nothing. Returning to our worksheet, we know that since all cap spreads priced in this column Z involve the combination of two caplets that are struck, as we said earlier, exactly 1 basis point apart, and this is true at every level of the spreadsheet, we know the payoff for each spread will always be either nothing or exactly 1 basis point, the difference between the two strikes. Note, and this was addressed in the earlier modules on interest rate caps and floors, that we are ignoring the very limited case in which LIBOR resets somewhere in between the lower strike and the higher strike, somewhere in between 5 and 501, which is of course pretty implausible. We remind you finally that a 1 basis point payoff on a $100 million notional, now that would be $10,000, and because we're dealing here with quarterly intervals or 3-month LIBOR, then that would represent a payoff of $2,500, ignoring the exact day count convention. We next consider what happens if we purchase a digital caplet with a defined strike, say 2%, and sell one with the same notional but with a higher strike, say 5%. The table appearing now summarizes the outcome, which can be stated in one sentence as follows. We collect 1 basis point if LIBOR resets between 2% and 5%. Otherwise, we simply lose our premium. We are done with our review and can turn to structuring our first range floater. Consider an investor targeting a $100 million 3-year principal protected investment and having the view that 3-month LIBOR will reset between 2% and 5% over this entire 3-year period. The guarantee of the investor's principal at maturity is achieved, as always, by investing in a 3-year zero-coupon bond exactly the amount that is necessary to collect $100 million at maturity. Seeing that the discount factor for period 12 is 0.8908, a number you do not see on the current worksheet but that appeared previously on worksheet pricing grid, we know that we can receive $100 million in exactly 3 years' time by investing today $89.08 million approximately in a 3-year zero. In fact, given the precise discount factor, it turns out the exact amount to invest is this $89,077,525, which would leave just about 11 million for the sexy stuff, so to speak, and to be more precise, 10,922,475 and $475. Next, suppose we purchase each digital caplet in this column AC, all 12 of them, having the 2% strike that you can see here, and we sell each digital caplet in column AI, which have the 5% strike. The digitals we are purchasing, we can see, cost $27,000 and change, and the ones we are selling cost $5,000 and almost the same change, and therefore in aggregate we would pay for all this just over $22,000. In fact, $22,032. We just established for the combination of digital caps that we were describing a cost of just over $22,000. Now, since we had 10,922,475 left after purchasing the 3-year zero, we would be able to purchase 496 times the combination of digital caps described just a minute ago, this being the ratio of the money available divided by the $22,000 premium per combination. In case it has not yet sunk in, we are in theory purchasing a vast notional amount of 2% digital caplets expiring on each LIBOR reset date, and selling an equally vast notional amount of 5% digital caplets expiring on the same reset date. The outcome can be summarized in this one sentence. On each reset date, if LIBOR resets between 2 and 5%, we earn 496 basis points annualized, otherwise nothing. Our investor is confident that LIBOR is indeed very likely to fall within this range on each reset over the next 3 years, so for her this instrument represents an attractive opportunity to earn an annualized return of 496%, consistent with her view, versus what you may recall is a swap rate of 385. So even if we subtract the usual subsidies that the issuer and arranger expect in transactions of this sort, we are able to create somewhere around 100 basis point yield enhancement for the investor versus the swap rate, and on a principal protected basis, and consistent with an interest rate view that she holds and that does not appear too aggressive. We show the term sheet for this version of the range floater, which should require no further explanation. Here is the skeleton of the term sheet, and here is the key range accrual sentence saying for each interest period LIBOR falls inside the range, interest for that period shall accrue at the subsidized rate, if you like, of 496 basis points, 4.96%. In determining an appropriate range for structuring these range-based instruments, you should, at a minimum, compare the boundaries of the range to the LIBOR forwards on each reset date. In the preceding example, LIBOR spot stood at 2.5%, then rose by 25 basis points per period and therefore reached 5.25% in the 12th quarter. Particularly with an upward sloping curve, the custom is to set the upper boundary either above or at the minimum only slightly below each of the LIBOR forwards. If necessary, lifting the upper boundary from period to period so as to keep it above the rising LIBOR forwards. In the present case, only the last LIBOR forward for period 12 lies above the upper boundary of the range that the customer requested, so this is more or less consistent with this general principle. The graph you're about to see is an excellent tool for conveying to the investor where the LIBOR forwards lie relative to the boundaries, with the LIBOR spot and forwards here being the red dashes that just appeared. And really, this graph should never be omitted from the marketing materials. Despite their weak track record as forecasts of future interest rates, the forwards are still viewed by many market players as some sort of base case scenario for what will, with reasonable probability, unfold in the future. So that a boundary that is wide enough to capture all these forwards goes a long way to enhancing the appeal of these instruments. It should be intuitively obvious that the tighter we make the range, the higher the yield we can achieve for the investor, but of course the greater the risk that LIBOR will reset outside the range and the investor's yield for that period would be nil. We illustrate this by repricing the range floater for a 2% to 4% range, using this time this worksheet labeled Digital Caps 2. This time we purchased the 2% caplets appearing in column AC as before, but we sell the 4% digital caplets appearing in column AG rather than the 5% caplets that we previously dealt with. Finding in cell AC23 a net premium of 17,856, calculated of course as the difference between these two premia, instead of just over $22,000 previously. As we just discovered, the tighter range from 2% to 4% costs a net upfront premium of $17,856 instead of $22,032 previously. Our option strategy has become cheaper, not surprisingly, since by tightening the range, we reduce the chance of receiving the payoff at maturity. Dividing as before the available funds of almost $11 million by this $17,856 reveals that we can execute this strategy a total of 612 times versus 496 times with a wider range. This enables us to amend the term sheet from the previous version to read as appears here, And on top of the skeleton that you see already, here comes now the tighter range with a 612 digital payoff. It is up to the investor, with some professional advice from the bank regarding LIBOR forwards, their accuracy as predictors, and generally the likely volatility of interest rates, to determine the appropriate trade-off between the targeted yield and the degree of risk she is willing to tolerate of losing her coupon altogether due to unreasonably tight boundaries for the chosen range. We conclude this discussion of range floaters by making a number of general observations about this instrument and its variations. Observation 1. It is quite common to include in these instruments a call feature in the issuer's favor that can be exercised after some specified number of periods has lapsed, often as early as the first coupon payment date. Of course, inclusion of this call option increases the stated coupon under the note, but also reduces the chances that the investor may find herself earning above the market rate for very long. Observation number 2. Many investors are turned off by the possibility of foregoing interest for an entire period if LIBOR on just one particular day resets outside the range. For this reason, a daily accrual feature is often included, which causes interest to accrue on a day-by-day determination based on whether LIBOR on that day falls inside the range. So if the annual coupon is stated to be 5%, for example, and LIBOR falls inside the designated range on 70 out of 90 days in a particular quarter, the investor would receive at the end of that quarter a coupon of 5% times a quarter times 70 over 90. In principle, we would structure such an alternative simply by purchasing and selling digital options, European style, expiring on each successive day during the life of the investment, and with equal notional amounts to one another. But in practice, such a hedge becomes very cumbersome and illiquid. So more sophisticated macro hedging techniques are used that are really beyond the scope of this module. Observation number 3. While LIBOR as an index is probably the most common interest rate index used, it is by no means the only one. Other indices used to some degree or other are the constant maturity swap rate, or sometimes the difference between two different maturities on the swap curve. We will be analyzing these more advanced instruments in a later module. Observation 4. It is also common to see range-based instruments structured on other asset classes, with currencies being the most common, followed by commodities and credit spreads. And last, the asset class on which it is rare to see these products tends to be equities, since investors are usually outright bullish or outright bearish on equities and rarely take the view that they will trade within a narrow range. This completes the chapter on range floaters and brings us to the final quiz for this module.